the markets love to focus on a single story when it comes to these sorts of issues, and they get, there's an obsession with it, and perhaps perpetuated by the media. In our judgment, the principal source of the problem in China was the credit slowdown and deleveraging that we've seen over the last 18 months. And that tends to lead both activity, profits, commodity prices in China and emerging markets more broadly, or the assets that are levered to China. Now, the bad news is that is back at 2015-16 levels when we last had a panic about Chinese growth. The good news is it's at 2015-16 levels, and the policymakers are starting to ease policy, both fiscal policy and starting to provide liquidity. I think the other issue, of course, is that it tends to lead by quite a long way, so it may take some time for those policy easing measures to gain traction, but that should be bullish for Chinese assets probably over the next 3 to 6 months.
Okay, China is in some ways trying to rebalance its economy. But at the same time, we have this looming trade talk that's happening between US and China, and that's going to be key next week. A lot of companies, that's creating a lot of uncertainty for companies trying to make investments into China as well. You don't think that's going to be a drag on the country?
Yes, I mean, I shouldn't say that, I shouldn't trivialise that, but I think it was an exacerbating factor rather than the principal cause of the problem that we've seen in both Chinese asset markets and emerging markets more broadly. And when I talk about emerging markets, around 1/3 of the MSCI EM index is China, MSCI China, and then another 25% or so is Taiwan and Korea. So a large proportion of EM is levered to China.
Okay, so you're trading mostly on the index, correct?
Yes, that's right. At the moment, we don't.
But if you look specifically within the sectors that are in China, I mean, we had Starbucks who say they're doing great in China. The middle class is doing great. It's consuming a lot of our products. On the other side, we have Intel saying, you know what, China's slowing us down a little bit there. So it's a tale of two cities, isn't it? Yeah,
no, that's a great question. And what we've done is in our judgment, the valuation in China is already trading at relatively distressed levels. Where there isn't distress is in assets that are potentially levered to China. And in one of the areas, and we're certainly sympathetic to the weakness we've seen in stocks like Intel and those sorts of sectors, but where we've principally focused our attention with regard to China, where it's not priced, is in the European luxury goods sector. Okay. We've actually got a short position there, and that includes a basket of the high-end luxury goods stocks. Okay.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.